Hi everyone, Don Singletary, and welcome to the channel. Today, a great subject coming up, how we can use the MACD and the S&P 500 Micro E-mini in order to scalp a few bucks off of a fairly quiet, low volatility market. And also some new tips on trading psychology. That and more coming up right now. Okay, if you're new to the channel, let me orientate you to the screen that I use. I try to be consistent about this because it's easier for you to learn when you see the same thing when you come back again, and you don't have to kind of start over every time. This is the S&P 500 Micro E-mini. I often trade the NASDAQ 100, but today I'm using the S&P 500 Micro E-mini, and my recommendations for the buy-sells are still the same, and those are these two things. If the green line, I'm looking in the bottom pane now at the MACD, if the green line's above the red line and they're both above the zero line, on the MACD, that's a buy signal. And you see we have one here just after 10 o'clock in the morning, and we're going to be talking about this and how to use the MACD to be able to gauge when to enter and also when to exit a trade, and perhaps even more importantly, how to manage a trade during the time that it's on. You can see that near 11 o'clock, the green and red lines right about here began to come together again. Now, this is a sign of weakening momentum. The momentum, of course, was up in this case. And when you see the convergence or the possible convergence, the green and red line coming back closer together, that means you are losing that upward momentum in this trade. Now, there are several ways to handle this, and we'll be talking about that. But if you have a nice profit in there and you want to be absolutely as safe as you can be, when you see this beginning to happen, you go ahead and take your profits out of the trade. But there are other alternatives. So let's zoom in on the trade here, take a little bit, just for the sake of argument. Let's say we bought in at a nice even number, 32.25 right here. Now we can see we're up to about 32.35 right here for now. One thing you can do, since the trend for the day does seem to be up, even though it's waning in momentum, is you could put a stop order behind this and lock in a certain amount of profit and then let the trade go to see if the profits run up even higher. Let's say we take half the amount that we have in unrealized profits so far and put a stop at 32.30. That would mean the worst thing that can happen in this trade is we would make 5 points, which would be $25. And then we're free to do nothing and wait and see if the trade goes up even higher during the rest of the day. Now, what you're doing, to put it plainly, is you're gambling half of your $50 profit that the market's going to go up from here above 32.35, and you would make an even higher profit. And you can move that stop behind the market as it goes up. Once you put it in, you can change that order anytime you want to, or cancel it altogether, or change your mind and cash out a higher profit or any profit that you happen to have at that particular time. But you are gambling a part of your profit to be able to continue in the trade, and there's no way around that. Now let me clear up some terminology for you. A stop order is sometimes called a stop limit order because it will limit the losses or limit the amount of profit you can make on a trade. There are two kinds of stop orders. There's a stop market order, and that would be if the 32.30 price is hit, you get the next available price in the market. That's a stop market order. The other kind of stop order is the stop limit order. That is, if you had it at a trigger price of 32.30, as we have here, and you had a limit on it, you could say, I wanted at least 32.29, or any number that you'd like to put in. So those are the two types of stop loss orders, the stop market and the stop limit. Another approach you can take to a trade like this is to buy two contracts instead of one. Now, the market moved 10 points between 10 a.m. and 11 a.m., And 10 points in an hour on the S&P 500 is not what I would call a fast market. A fast market is a volatile market that can move really fast in either direction and do it rather quickly, more quickly than you realize sometimes. But you could have started with 2 contracts, and then you would have had this choice. When the price got up to $32.35 instead of $50, now you would have 10 points, but you would have 2 contracts, so you would be up $100. You could still put in a stop order for half of that, or you could cover one of the contracts. Now, cover means you exit one of the contracts. You would have, since you were long 2 contracts, you would have sold one and kept one at $32.35. So you would have locked in $50 of actual realized profit in your account. Then you will let the other contract go and see how that turns out for you. Okay, now I want to ask you a really important question. So you see what your choices would have been on the trade. I don't know what you would have chosen. Maybe you do, but let me ask you a question. Don't you want to know how it turned out? This chart ends at 11:09 in the morning. You want me to show you the next 45 minutes and see how it turns out? Done. Well, as you can see, there wasn't a lot to be gained over the next 45 minutes. That width of yellow up there is the 46 minutes exactly that you had to wait, and you would have gotten another 1.5 in 46 minutes. It's really hard when you're trading to wait 46 minutes for the market to move one way or the other, and you're second guessing all of your decisions and yourself. It's just plain old trading psychology. The longer you're in limbo, the more you begin to doubt your decision, and the mind does play tricks on you that way. One of the dead giveaways here would have been that MACD line. Look at it between the 11:09 and the 11:55. I'm talking about the red and green lines in the bottom half of the screen here. Now you see the momentum clearly was going nowhere for that entire 45 minutes. That's what the green and red lines being together so close and not moving either apart or together much at all. That's what that means. And when you see the momentum wane like that, now you can't tell the future, but the longer you sit there, the more it reveals itself to you. And like I say, you can't tell the market how much money you want today. It will tell you what it's giving away and what it isn't. And so you learn how to read that MACD. It saves you wear and tear on your trading psychology. And it also gives you a little bit of a guess as to what might be coming up next. Be sure and subscribe, because next week we'll be doing some more S&P 500 micro E-mini trading, and specifically more about scalping trades and how to identify some opportunities based on the market volatility. It's going to be an interesting video. Subscribe now so you'll be notified. And please hit that like button. It's the way I tell what you need and want in your next videos. It's the way you tell me by clicking the like button that, yes, I want more videos like this one. I would really appreciate that. It helps me do the planning and to make the videos that you want to see. Thank you. I want to talk to you a minute today about the psychology, trading psychology tip of the day. There are 2 things, but they're really the same thing. Now, let me try to explain that. One of the worst things you can do as a beginner is say, well, I think on Tuesday between 9:30 and 10:30, I'm going to do some trading. Well, that way you're kind of telling the market to get ready for you and get some money ready because you're coming to get it. And that's not how it works. You have to study the market. What I'm saying is that's a backwards approach. You study the market. Some days you're going to be there. Patience pays, and there just isn't going to be a trade. And if you show up with a mindset of you're all dressed up and there's no place to go, it's going to cost you money. So don't do it. And the second half of that tip is don't overtrade. Sometimes you may say, well, I've got another hour to go. Let me see what I can find to trade here. And that kind of thing is a beginner's mistake, because The market will let you know, and you learn this through your experience and your practice trading, when you might be able to make some money. You don't get to tell it will tell you, is the way I usually put that. But try and remember those two things. And by the way, if you're new to the channel, if you're a beginner, I have 2 playlists designed to catch you up to speed on all the terms and everything. You'll see the beginner's playlist in the text below this video. Also, I want to talk to you just a moment. If you haven't seen my book yet, it's a great way to get all the information you need all in one place. And what does that do for you? Well, it saves you a lot of time because you have everything, all the terms and procedures and things about how to pick a broker and the types of orders you trade, a whole chapter on trading psychology. It explains the MACD a little bit in there for you, and it's kind of a supplement to all the videos here on the channel. And it only costs a little bit less than a Chick-fil-A with waffle fries. Maybe I shouldn't say it that way, but there's a link below that's called the book down there, and I hope you'll check it out. You can see the table of contents with a look inside feature on the page at that link down below. So if you would do that, I would appreciate it. It is the book sales that help support the videos here on the channel. This is Don Singletary. It's been fun today. I hope every day is a payday for you. And thank you.